Good day, you're welcome to my channel. This is Kevin Davis Accounting. So we are still continuing with our video on the conceptual framework. Remember, firstly we had talked about the purposes of the conceptual framework and we looked at the components of the financial statement. Now allow me look at the issues dealt with. In the conceptual framework. So the issues that are dealt with in the conceptual framework, one, we have what they call the objectives of financial statements. I'm going to explain one by one. So we have objectives of the financial statements. Then two, we have the user groups or the users of financial statements. So these users, like I explained in my introduction, still I'm going to explain them here. Then we have assumptions underlying the preparation of financial statements. So you're going to look at these assumptions as well. Then four, we have qualitative characteristics of financial statements. We have the qualitative characteristics of financial statements. Then we have elements of financial statements. Remember, I told you we have a difference between components of financial statements and elements of financial statements. So in my previous video, I looked at the components of financial statements. Now I'm going to look at the elements of financial statements. Then also I'm going to look at the concept of capital and capital maintenance. Concept of capital and capital maintenance. And then lastly, we are going to have the reporting entity. Ladies and gentlemen, these are the things that we are going to be looking at. So these are the issues that are dealt with in the conceptual framework. Ideally, this is all you should know when it comes to the conceptual framework. So I'm going to handle one by one, and I know at the end of it all, we shall have a full apprehension of all this. Now, I am going to I'm going to go one by one as I explain. Then later on, we shall have our understanding enhanced. So allow me to rub off this, then I start with the objectives of the financial statements. When it comes to the objectives of the financial statements, of course we have three of them. We are going to say to provide information on, then we start to mention. One, to provide information on the financial performance of the business or of the firm. Okay. Then two, to provide information on the financial position of the firm still. And then three is there to provide information on the cash flows of the firm. I think you can see these objectives are coming from the components of the financial statements. Like you can see, the objectives are there to provide information on the financial performance of the firm, on the financial position of the firm, and also on the cash flows of the firm. So this is what we have by the objectives of financial statements. Then next we had what we call towards the user groups. The user groups. Who are the users of this information, or the financial statements, or the accounting information. Now, you know very well that we have two classes of users. We have the internal users and we have the external users. So we can have investors, we can have lenders, we can also have the management, okay, we can have the government and its agencies. Okay, so even employees. It is, there are so many users of accounting information. Even customers can be, even suppliers. We have so many. Now, I remember in my introduction to financial accounting video, I told you that when you're explaining users of accounting information, one, you define who this person is. You define that group of people. Okay? Then you define what they're going to use the accounting information for. Then you also make sure you explain the decision they will make. For example, I talked to you, I say that the investors, who are the investors? Because they can bring such a question and they tell you maybe you're supposed to explain the users of accounting information. Then you can find that one is 3 marks. Okay, so you mention the person, the investors, who are the investors, you see. Then you also mention what they're going to use the accounting information for and the decision they're going to make. For example, the investors, these are people who inject money into the business for a return. Okay, then after that, they use the accounting information to see whether the business is profitable. So the decision they make is, if the business is profitable, then they will go ahead to inject in money. If the business is not profitable, they will not, or they will withdraw. Okay, so that's how we can explain the user groups. So I've just given you an example of this, but if you're not so comfortable about this, you can go back to my introduction video, Introduction to Financial Accounting, and you have so much about this. The next, the third one was, we had what we call the assumptions underlying the preparation of financial statements. So when we talk about the assumptions, we are going to have one is the accrual basis. Okay, now the accrual basis, it states that revenue is recognized when it is earned and not when it is received. Okay, revenue is recognized when it is earned and not when it is received. Okay, and likewise, expenditure also is recognized when it is incurred and not when it is paid. Now look at this. For example, they can let me just give you an example of rent. Okay, so if we pay rent, let me say worth 50,000 Ugandan shillings, 50,000, and then in the question they tell you that half of the rent is for the forthcoming financial year. Okay, half of it. That means we have a rent prepaid, which is for the next coming financial year. How much? 25. Ideally, it means we did not, as much as we paid this, we did not incur this. No, we incurred 25,000 because remember, the 25,000 is what we paid, what we were supposed to pay. The 25,000 is for the forthcoming financial year. Okay, so that means this one we do not need it. Okay, so by the accrual basis, we are going to say rent is recognized as it is incurred, not as when it is paid. So we paid 50,000, but actually we only incurred a half of the 50,000. So it means the 25,000 is what we are going to recognize. That's what the accrual basis states, that expenditures, they are recognized when they are incurred and not when they are paid. And also revenue is recognized when it is earned and not when it is received. So that's what they call the accrual basis. So that's all about the accrual basis. Then we also have what they call the going concern. The going concern concept. So what is the going concern? Now, the going concern, this states that the business is going to keep in operation into the foreseeable future. Okay, so it means that the business is going to operate even beyond the 12 months period, which is the accounting period. So that means the business is not going to stop tomorrow, it's not going to stop next month. The business has to keep into operation. So the going concern, it states that the business keeps an operation into the foreseeable future. So that means that the business is not going to stop in the next days, in the next months, but it's going to keep going on. When we are calculating, there's something we call the balance brought down. So I see this balance brought down when you are calculating now books, like you can see in our videos. Balance brought down, it means that is the balance that you are going to take to the next period. Okay, that means if the business is operating this month, and let me say we end with a certain amount. Now this amount that has ended as the balance in our drawer, this is the balance that we are going to start operations with the next month. So the going concern brings about this, that we are going to keep operating. The business is not going to go into liquidation. It is going to keep we're going to have an operation irrespective of the time and when. So that means that's the going concern concept. So it speaks about us keeping in operation. So actually, even budgeting came about because of the going concern, because you budget into the foreseeable future. So you say, maybe you start budgeting. Maybe let me say we're in 2025. 2025, you start to budget for 2026 as well. That's why people even have goals. They start setting goals, like maybe by this year, we have a 5-year plan, a 10-year plan. So those things come about because of the going concern, because we expect the business to keep in operation for a long period of time. So that's what they call the going concern. Then 4, allow me to talk about the qualitative characteristics. So let me rub off this. So allow me to talk about the qualitative characteristics, which is the number 4. We have the qualitative characteristics. Now, this part, they like setting this part so much for students. They like setting it so much. So when it comes to the qualitative characteristics of financial statements, these ones are divided into 2. Okay, we have what they call the fundamental qualitative characteristics, and also have the enhancing characteristics. Okay, now these are the 2 branches of the qualitative characteristics. So when it comes to the fundamental characteristics, these ones are subdivided into 2. Okay, we have relevance here, okay, and then we have faithful representation of financial statements. Then here we can further subdivide this into 1, comparability. We have verifiability. We have understandability, and we also have timeliness. These things should be at your fingertips because they like asking this so much. So when you talk about the quantitative characteristics, 1, we have the fundamental characteristics and the enhancing. Now, when it comes to the fundamental characteristics, we have what they call relevancy. So it means that the financial statements that you are preparing, they should be relevant. They should be able to solve the need of the user. For example, if I need financial statements, or if I need information concerning sales, and then someone gives me information concerning purchases, then that person has given me information which is not relevant to me. Because what I wanted was sales. It was not what? Purchases. But this person gave me purchases instead of information on sales. So that means relevancy. It means that this information that's being given, it should be able to solve the need of the user. So if I'm the user and I've asked you for a particular information and you give me an information contrary to that which I've asked you, then that information is not relevant to me. Okay? Then, when we talk about faithful representation, faithful representation is so much like when we present our financial statements. These financial statements should have transparency. These financial statements should be prepared with integrity. Now, for us to have a faithful representation, the financial statements should be, for us to have a faithful representation, the financial statements should be one, they should be complete. That means we should not leave there anything, okay, when you are preparing the financial statements. That's what they mean by it being complete. When they are complete, then that means we shall call for a faithful representation. Then they should be neutral. Neutral. What do I mean by them being neutral? They should not have any bias. Okay. So as an accountant, when you prepare these financial statements, you should not have any bias. Okay. So they should be neutral, and lastly, they should be free from error. So they should be free from error. So that's what we call faithful representation. So for you to have an information which is faithfully represented, it should be complete, neutral, and free from error. So that's what they call faithful representation. So when it comes to this side still, on the enhancing characteristics, we have the comparability. And when we talk about the comparability, one, you should be able to compare the financial statements. Probably when you go back to the old financial statements, you can compare them with the current financial statements. So there should be an ability for you to compare the financial statements. Verifiability, it means you can trace back and verify that these transactions took place from the source documents. So if the financial statements are verifiable, that means the source documents are there to support what you have put into the financial statements. Then understandability. Understandability, it means that the financial statements that you have prepared, they are easily understandable. Okay, that when someone gets to read through your financial statements, the financial information that you have presented, this person will actually understand the information that you have put down. Then, timeliness. The financial statements, of course, should be timely when you're presenting them. Of course, you should have a period of us preparing the financial statements. You all know that we prepare financial statements every after 12 months. Okay? And 12 months makes up what they call the accounting period. I don't want to take, say, from January to December. Some might start even from, let me say, July to June. Okay, 1st July to 30th June. So it depends on the organization's policy. Okay, but some might even do from 1st January to 31st December. But as long as it's a 12-month period, because that is the accounting period. So that's all about the qualitative characteristics of financial statements. I'm going to have a separate video about this topic alone. Now, what I've covered here is I'm just beating a bit for you to understand it in conceptual framework. But I'm going to have a full video on the qualitative characteristics of financial statements.